What is going on, you guys? All right, time for another Sunday live stream. Still got to get a couple things. Looks like there's just a couple people joining in right now. Want to make sure that I'm sharing my screen. We have quite a bit of stuff to talk about today. Last week was absolutely wild week. My portfolio in general, I got to make sure I'm doing this correctly. I'm going to eventually go to this screen here. Okay, so I believe that my audio is working. I'm using a new audio. So if you guys can't hear anything, just make sure you throw something down in the comments down there. But if not, then I'm just going to assume that it's all working. Okay, so we had a lot of things end up happening last week in the financial markets. You know, Tesla ended up reporting earnings, Meta reported earnings, Microsoft and Google reported earnings. We learned a lot. So if you guys have been tracking so much this year, what we've seen a lot of high duration, high beta stocks really sell off pretty aggressively to really kick the year off. And this does have a lot to do with the rising yields, specifically the 10-year yield. And more importantly, we've seen just a ton of volatility in the markets, even though that the S&P 500 has dropped maybe, hey, what's going on, Sam? Even though the S&P 500 has dropped maybe, let's say 4 or 5% to, I think, from the recent highs, there has been a lot of things like Tesla is down 35% now. There's this weird bifurcation in the markets, and I noticed that this started happening in February. And I believe that right now we're at a critical juncture, and I do think that things are about to change. And the reason why I think that things are about to change is really has to do with the bond market, more specifically like how stocks react to the bond market, and more importantly, like the overall trend of inflation and what we're expecting for the CPI and the PPI, as well as the PCE index for the month of April, because we're heading on into May here this week. So a lot of interesting stuff to talk about here today. What I wanted to do is actually kick off, talk about Tesla's earnings and Meta's earnings, and more importantly, really dig down deep as to what I ended up actually seeing in these earnings reports and why both reports. So there was a lot of confusion with the Tesla bears, wondering why Tesla could ever go up on those results. Or from a Meta perspective, why was Meta actually down on those results? You know, they beat expectations. Meta ended up beating expectations, but it dropped, I think, 16% after hours. Finished the day after that. Hey, what's going on, Brock? Finished the day after that, I think it was down 10%. So Meta recovered a lot of those losses, but still, at the same time, a lot of people are usually confused as to why this stuff happens. But it really comes down to something pretty simple. There's a business underneath every single stock, right? Meaning that it's not a stock, it's a business. And there's also business expectations that end up coming from that. And it was the expectations that was, number one, priced into the stock, and then also what was talked about on the earnings call. So I'm going to go over those, and I'm also going to talk about Microsoft and Google's earnings and what I ended up seeing from a cloud perspective, because there is a lot of cloud. I own a lot of cloud stocks. I think 5 or 6 different cloud stocks out of a 22 stock portfolio, because I really do believe in the data infrastructure revolution, artificial intelligence, and things like that. But obviously, with AI and stuff, I don't necessarily like to think of it as just AI. I really like to think of it a lot more, because I've owned these stocks for years, and way before ChatGPT was ever a thing. It's really a lot more along the lines of the evolution of how data infrastructure has been built out, right? That really started back in 2012, 2014 timeframe. Big data was the big terminology then back in 2016. And I know this because I used to work at Gartner. Anyway, but I'm going to talk a lot about Microsoft and Google's earnings, and then really, so we actually have a lot of stuff to talk about too when it comes down to the Fed. More importantly, the Fed's rate, the rate expectations, right? So it's not necessarily that we have the Fed coming out this week. What it really comes down to is it actually comes down to what is Jerome Powell going to tell us? Because we went from, this has only happened over the past 2.5 months, and a lot of people end up forgetting about this, but we went from pricing in 4 to 6 rate cuts this year to now 0 to 1. So what is actually the reality here? And that's what we're going to be watching for this week, especially when we're talking about Jerome Powell and what he ends up talking about in this, the FOMC presser. Is he going to backtrack a lot of the guidance that ended up happening from the SEP that was released to us in December? I don't know. Or maybe it was March. I don't know. But the last time they ended up talking to us, we had the SEP. And there was guidance that we actually were going to have 2 or 3 rate cuts this year. So now we went from pricing in too many rate cuts to not pricing in any rate cuts. And I do believe that this is going to be the crucial week that actually causes the inflection point in the markets. And I'm really believing that. You can't always say things with like 100% certainty because shit, man, it's the financial markets. I've been wrong so many times before. It's like, so you just got to hit, I'm just sharing my perspective. I believe that I'm right. I believe that this is all going to shake out and it's going to be very bullish from here on to the end of the year, especially from a lot of the stocks that I own. So I'm talking about like high beta, high duration, or long duration stocks. I believe that those are actually going to be the outperformers to lead the back half of the year, and also like Tesla stock. And there's a big reason why. So we'll talk about that. All right, so let's get into it. Let's talk about Tesla's earnings to kick things off. So one thing that this is what drives me crazy is that a lot of people end up talking, and I've been doing this for years, and it's just a complete anomaly to me that people still don't understand that there's a business behind these results, right? And there's a business that is affected by not only just like the macro economy, but more importantly, like how is the story evolving? What are the expectations? So there was a couple key highlights here that I wanted to make sure that I was emphasizing from Tesla's call. So there was both short-term expectations, a change in expectations in the short term, and then also a change in expectations from the long term. So if you guys do remember, and I'm just going to switch to my face here real quick. If you guys do remember that the narrative here to really lead Tesla lower in the front part of the year was no Model 2, right? And they were also saying that EV adoption was just going to complete crap, which it kind of is, but it's kind of not. There's still a secular trend here to be had. And then more importantly, like the autonomous vehicle, narrative, and there was just a lot of uncertainty. And people were even saying like Tesla may actually contract in revenue this year. So that's exactly what Elon ended up talking about to really kick off Q1. So during the earnings call, they ended up saying that Q2 should be meaningfully better than quarter one. This was important, right? And the reason why this is important is that this does adjust those short-term expectations that Wall Street really cares a lot about. And not only that too, but also from a longer term, like a full year perspective, they do expect some sort of recovery in the deliveries numbers, and they do expect to grow their deliveries on a year-over-year basis, and thus grow the revenue in their automotive business. Because if you guys can actually remember some of those not the highlights, but like the headlines. I meant to say the headlines. They were talking about that Tesla could just not grow anything this year. So there was a lot of ease put into investors' minds during that time. But I do think that there was something crucial, absolutely crucial, said on that earnings call that nobody is really talking about. And this led me to increase my position. Man, I want to say it was like 10%. I think 10 or 15%. Again this week, and this is after really accumulating it heavily. So my cost basis right now is about $180. So I've been waiting for this moment for a long time. And I'll do the same thing for NVIDIA. When I want to own NVIDIA, but it's just right now I can't add it because there's too much hype and excitement priced into the stock. And I always thought the same thing about Tesla. So I waited probably about 2 or 3 years before I actually ended up buying the stock. And anyway, so the short and medium term expectations are improving. And one thing in particular is that they said that they were going to release the robotaxi as well as Model 2, and they could potentially begin production at the back half of this year or early next year. This does play a difference into like how analysts are going to model their expectations in the short term. That means that on a full year basis for 2024 and then also for 2025, because I always like to make sure that I'm paying attention to the next 12 months of earnings expectations, because that's exactly what the market pays attention to. They don't really care about what has happened. It's like what's going to happen in the future. And that's a huge reason why we saw Tesla run so much in 2020, is that there was that inflection point, right? Where they actually saw, oh, holy shit, like this company is actually going to scale to profitability. Same thing, right? Now we're at that inflection point of Tesla's not going to grow at all. Now we're actually entering into May. So now we're heading into June here in a couple weeks, like 3 or 4 weeks, which basically means that we're halfway through 2024. Like what's going on in 2025? That's how investors are going to start thinking. And I do think that from like here, I think this is actually the Tesla bottom. I've been saying this for a couple weeks now because we're actually seeing a lot of positive divergences. So I do think that right now is a Tesla bottom. I do think that we're going to start looking to 2025 where they are going to start scaling production. There was one thing in the call that really stuck out to me. So they said they were going to take their current production capacity. So that means that they weren't going to increase their variable CapEx. And they were going to scale from 1.8 million vehicles, what they're producing right now, to 3 million vehicles with 2 new vehicles. So basically think about it like this, that they're going to take their existing infrastructure without with minimal investment, which this is going to be beneficial to the free cash flow margins and the EPS margins. And then they're actually going to increase almost double their capacity or double their deliveries from the initial, from their initial infrastructure that they have right now. And then we also have autonomy that seems like it's on the 10-yard line or the 5-yard line. Like they're about to score. They're in the red zone. So there's a lot of things that are really optimistic about Tesla. Now let's talk about Meta though. So like what ended up happening with Meta, right? And I think that there was one part of the earnings call that really stuck out to me here. I do think that when Meta was going through that catastrophic bear market, I'm actually going to pull up on a different screen right here. I'm going to try to multitask. So Meta, if you guys remember that this is a time that TikTok was performing extremely well. And I'm making sure that I pull up the Meta chart so I can put this into better context here. TikTok was performing extremely well, but not only that, but Mark Zuckerberg, what he was doing during this time. So this is what I'm thinking about. During this time right here in 2022, Mark Zuckerberg, he was actually increasing a lot of investments into the metaverse. Hold on, just a second. He was increasing a lot of investments into the metaverse. And basically during this time, this was so like, you got to think about the way that Wall Street thinks, right? More specifically, like the analysts, when they release their notes, they always want to see some sort of return on capital. Like they want to see like, hey, you're investing capital into the business. Like what's the return on this? Zuckerberg during this time was investing a lot of money into the metaverse, but there was no clear direction as to what the metaverse actually was, right? And I still don't even really know exactly what the metaverse is. And I don't even know if Zuck knows it. I mean, we do kind of know. We know it's a virtual universe that's going to connect people. We know that. But like from a Wall Street angle, just like how Wall Street's not pricing in Tesla's autonomy right now, is that they want to see the money now. And they want to see like what's going to happen over the next 12 months or even like 2 years so that they can actually model this out and price it into the stock. And I do think that that's exactly what's going on here with Meta. So like during this earnings call right here, there was this part where they were actually talking about like, where is this going to be? Like, where's the growth going to come from over the next, let's say 1 to 2 years? And what Zuckerberg is essentially saying, and this is right in the earnings call, and I'll make sure that you guys can take a look at it yourself. So what Zuckerberg ended up saying is that he's basically thinking that they're going to want to invest into AI now, or like Meta AI, not the metaverse as much anymore. And they're also going to not disclose any of the Reels numbers anymore. So it's kind of like, from an investor standpoint, I don't have a position. I'm not going to short Meta. I would never do something like that. And I'm also not, it doesn't really make me super optimistic into buying the stock. I do know that there's a lot of people who own the stock, so don't hate me when I say that. But I'm just providing a different perspective from the bull's perspective, where I'm taking a third-party, unbiased opinion, and I'm looking at the company, and I'm saying like, okay, so Zuck, you were on the metaverse about a year and a half ago, and now you're in on Meta AI, and this has changed over the last 3 months now, apparently. So it's confusing to me. It's confusing, and I'm sure it's confusing to a lot of investors, where it's like, all right, so Reels is kind of maxed out, Instagram's kind of maxed out, Facebook's kind of maxed out, like WhatsApp, who even uses WhatsApp? I know I don't use WhatsApp, I use like Discord and stuff. So like, where's the next phase of growth going to come from Meta? And not only that, but they're actually talking about increasing their expenditure into Meta AI. So it's like, could it be something that pays off in the future? Absolutely. And I'm not saying that it's not, but I am saying that the way that Wall Street thinks is that when you invest into a company or when you invest into a project, they want to see some sort of something come back. And there's no clear of like comeback. There's no return on invested capital here. It's just basically Zuckerberg's just investing into whatever he thinks that Meta could potentially lead, like the next phase of growth for Meta. And it's not the metaverse. It may not even be Oculus. It may be Meta AI. We don't know. So that's just definitely a unique perspective that I had. But I want to make sure that I'm talking about like something that was really, really optimistic that ended up coming out here. So I think that this is actually from Ophir. So Google Cloud and Microsoft came out and released, and this is what was important to me, is that Google, yes, what an earnings. That was like the best earnings I've seen from Google for the past 2 to 3 years. But what was the most impactful to me is that not only that, they were actually really profitable. And then they did release their dividends. So now growth investors are now dividend investors, right? It's kind of funny. So they did actually announce a dividend. But what was really impactful to me, what I paid attention to the most, is that their cloud growth really crushed expectations. So you can see that they were expected to grow 25.4% year over year, but they actually came in at 28.4% year over year growth. Now, this was a big deal. This is a really big deal because those are the stocks right now that have actually getting absolutely like smacked to start the year. So like Zscaler, I think that's down like 15 or 20% year to date. MongoDB is down like 15 or 20%. Snowflake is down like 20%. So like all these data infrastructure stocks, they've been absolutely just whacked to start this year. But now what we're seeing is we're actually seeing a lot more, we're seeing a lot of really, really solid earnings come out for even like Microsoft too. And oh gosh, man, I think I lost my Microsoft thing. That's all right. So Microsoft ended up doing something similar too. So like Microsoft ended up coming out and they actually ended up guiding for, so Azure came out, and I can actually remember these numbers. Azure came out and the numbers were 31% year over year growth. And then they actually ended up guiding for 31% growth for the next quarter too. And it's actually their quarter four. But that's basically the next quarter that we have. So it's like the real quarter two, but it's their quarter four. So they call it quarter four. But they actually guided for increased revenue, and that beat expectations. So they beat expectations this last quarter. They guided for accelerated revenue growth next quarter. And Google essentially did the exact same thing. So cloud is right now, I think that there's a massive opportunity, especially when we're thinking about like how the infrastructure investment goes. So to start things out, like we actually have to build out the hardware, which is why NVIDIA, SMCI, like those stocks, a lot of the data hardware or the data infrastructure stocks, like those stocks have really, really benefited from the AI generation. But what's going to come next is actually going to be a lot more sustainable, and it's going to occur over a longer period of time. And what I'm talking about is like the software and application standpoint. So like when you think about AI, like what the is AI, right? Like, excuse my language, but at some point it's like people just say AI, and it's like, you're like, what do you mean by AI? It's getting to be such a buzzword these days. But essentially it's like, what is the business case? Like, what is the usability? What is the application? Is it another freaking chatbot, like another Chat GPT or a Meta AI or a Grok? Like, I don't know what it is anymore. It's just like people are just saying artificial intelligence to say artificial intelligence. But from my perspective, it's like AI does have, and Gen AI more specifically, does have use case applications. Like there's going to be a usability to artificial intelligence, much like Tesla's FSD software, right? Now that is AI that can be used and can be used to monetize, like with the robo-taxi network, which is going to happen. But not only that, but there's actually going to be some software applications that will come out over the next probably a year or two. We'll probably start seeing in the public markets in the next 3 to 4, maybe 5 years. But that's like the next phase of this artificial intelligence scale out, like, because it's a real technology. It is happening. This is the AI revolution, but the AI revolution is a lot more along the lines of like the evolution of what was existing before, like cloud, data, data cloud. And then now it's going to be artificial intelligence, which is nothing more than how do you decipher and filter through all of this large sum of data that we have? Like, how do we actually use it? That's artificial intelligence, right? That is exactly what artificial intelligence is. And I don't think that a lot of people even know that or even understand it. So so AI is a data strategy. All right. I've been talking you guys' ear off for 20 minutes. Let's get into some earnings here. Okay. So in the morning, we got SoFi. A lot of people are going to be paying attention to that. I think that what's really, really important to pay attention to with SoFi is that, so it's a bank stock. And I think that a lot of people think of it as like a fintech first, but it is a bank stock. SoFi is a bank. So you got to think, if you want the share price to appreciate over a long period of time, you got to think to yourself, like, how are they going to grow their assets, right? How are they going to increase their price to book ratio over time? I love SoFi. I use SoFi. I have a SoFi credit card. So I'm not bearish on SoFi in any way, shape, or form, but I am just saying, like, that's how Wall Street is thinking about this. Like, there's a price to book ratio to be had here. But we do have really, really big earnings coming out this week too. In like Amazon, AMD, some people are going to pay attention to SMCI as well as Apple. I have DraftKings and Cloudflare, and then I do think that Mercado Libre reports this week too. I think that they report on Wednesday, if I'm not mistaken. But we got a lot of those really, really big earnings, really important earnings. So like AWS is going to be influential to a lot of software stocks once again. Because if AWS comes out and they say, we're seeing accelerated revenue adoption. Maybe they do decipher it between AI and non-AI like Microsoft does. But what I'm seeing, even for like GCP, so Google Cloud, that it didn't matter if it was AI revenue realized or not. I think that AWS is going to show something similar too. I do think that Amazon, although has seen a massive run, something tells me that they're going to crush it, and they're going to crush it from the e-commerce perspective. I do think that AWS is going to crush it too. AMD, the story to pay attention to here, I could definitely see the stock going up after hours after missing expectations or whatever it might end up being because of the MI300 story, right? So like what's going on? This is going to provide really good visualization to even like NVIDIA, right? So AMD's earnings are very important to NVIDIA in the sense of like what's going on with the semiconductor component of this AI build out. Like, are we seeing increased adoption? Are we not seeing increased adoption? Are we seeing much more of like a stabilization? Like, or even more importantly, like how much market share does AMD think that they can take from NVIDIA? Because right now NVIDIA is thinking that they're just going to be this dominant, and they probably will, but there are going to be competitors that step into the market, and AMD is a clear number two. And it's very obvious. So I know that I own AMD, but I think that that's going to be really important to pay attention to. And like SMCI too. So that's SMCI is right underneath AMD there. Like, why didn't they pre-release better than expected numbers? Because they have done that for like the past 3 to 4 quarters. This year, they didn't do it, or this quarter, I should say, they didn't do it. So that's going to be very important to pay attention to. Like, why didn't they? Like, how are their numbers evolving? Because I do think that NVIDIA stock is going to trade based on that. Now I have Cloudflare and DraftKings, and then I do think that I have Datadog reporting this week as well. If I'm not mistaken, I got this actually pulled up. But for those companies, for those stocks in particular, I do think that with like DraftKings and Cloudflare and Datadog, they're all going to, so DraftKings is going to be a little bit separate, but like Cloudflare and Datadog and a lot of these data infrastructure stocks, I think that they're going to trade really in line with a lot of these hyperscalers, because as these hyperscalers grow, they intrinsically and naturally grow as well. So like DraftKings is actually going to be one of a trader stock right now. So there's a lot of people who are really actually into this stock, and I see it all the time, especially like the Can Slim guys. So what I'm going to be really interested to know is like what from like March Madness, like how did they monetize it? What sort of betting did they see from March Madness? Like, how did they see the NFL season shape out? Like, especially in the Super Bowl, because that all happened. The Super Bowl, March Madness, all happening in Q1. They're going to talk a lot about that. And then more importantly, like, how is their new acquisition going? So they actually have like a lottery acquisition. I want to know more about that. I want to know about more states opening up because we're coming into an election year. So DraftKings is a very, very young and unique story. They're just reaching profitability. They should actually reach GAAP profitability sometime this year. Right now, they're non-GAAP profitable. I do think that they're going to reach GAAP profitability sometime at the back half of this year. But anyway, a lot of great things that are coming out this week. I'm going to be busy because I usually cover all these companies. But what I want to talk about here is I actually want to talk a lot about opportunity here. So remember how I ended up talking, like in the beginning of this, I said that a lot of high beta stocks have really sold off to start this year, right? But there's a direct correlation as to why this is even happening in the first place. So when you actually look at like what's ended up happening here, the 10-year yield, so I should probably zoom in here. The 10-year yield is actually approaching like the correction territory that we ended up seeing in October. So if you guys can recall, that's actually when we bottomed in the financial markets before we absolutely took off like a rocket ship. And then this right here is actually going to be where we started the year. And the 10-year yield is up approximately 21% on a year-to-date basis. This has put in a lot of pressure, especially within long duration stocks, because they're cyclically sensitive. They're interest rate sensitive stocks. And not only that, but we've seen that steady bearish, that bear steepening too, where we're actually seeing the yield curve uninvert because now the 10-year yield is actually getting closer to that 2-year yield. So we're actually seeing or not a steepening. Yeah, it is a steepening. We're seeing a steepening of the yield curve, and it's not necessarily going to be. So like this is actually really important because historically speaking, right? It's about 6 to 9 months, sometimes 12 months after the yield curve uninverts. And so it's not the initial inversion that creates the recession. It's actually the uninversion. So once the yield curve uninverts, then that's usually going to be that moment where we're going to be in a recession, an economic recession. So that's something that I've been really paying attention to, because I don't know, because like as it stands here today, this sounds like if it uninverts at some point this year, that tells me that there could potentially be a recession. From a historical perspective, I don't have much opinion about like if we're going to be in a recession, if we're not going to be in a recession. I really just look at the numbers and the data and historical trends and patterns we've seen before in the past. And the patterns that we see before in the past is that historically that there's usually a recession about 6 to 9 months after. And I can actually just show you guys that. So right here, we see that the yield curve uninverted in March of 1990. And then right there, July, so it's Q2, so 3 months later of 3 to 4 months later, they were in a recession. So we were in a recession, meaning the United States. Same thing ended up happening here, where it was like that 2000 timeframe, December 2000. Then March of that year, we found ourselves in an economic recession in 2001. So that was 3 months after as well. Same thing happened in 2007. May 2007, yield curve started uninverting. In December of 2007, so that was 6 months later, in December of 2007, we were in an economic recession. So that's something that's really important and even like all the way back here in this 2019 timeframe. I know that it was COVID, but that's a little sus. I don't know. The bond market saw something, but we ended up going into that COVID-induced recession approximately 6 months later. So that's something that I've been paying attention to. It's like, is history going to repeat again? Possibly. I want to see it. I actually want to see exactly what the yield curve is going to do, because this is going to lead to a sell-off in the markets, like 20% plus, probably a retest of the 200-week moving average, if not lower. So for context, like what this basically looks at right here, this is the S&P 500. I got to make sure I'm sharing my screen. Okay, so if you look at the S&P 500, that would be like a retest down here of what would be close to the October low if it just dropped tomorrow. But obviously we have a trend here. So, I mean, it's not too much of a devastating correction if we do actually uninvert anyway. So that's always something that I'm paying attention to. But we do have a lot of data that's coming out this week, more importantly on the topic of like Jerome Powell. So Jerome Powell is going to be talking this week on Wednesday, and they're going to be talking about like the rate decision. I don't think that their rate decision is going to be that impactful. I actually think that what's going to be the most impactful is how he talks about like how they're seeing the inflation data roll out. So it's really not as bearish as people think. So I wanted to show you guys that there's two things. There's two important data points that they pay attention to here. And one of them is actually going to be the core CPI. And so you can actually see here that the core CPI has been gradually dropping over the past, let's say probably for about a year now. For the past couple months, we have actually seen that trend continue to go down. Yes, there does seem to be a little upward here. It is getting a little bumpy, but for the most part, the trend is still down. That's in the core CPI, and then the PCE is showing something very similar. So the core PCE, which is what they pay attention to the most, which is actually the most important for them, has seen that gradual decline. And not only that, but we actually see that the Cleveland Fed, so the Cleveland Fed, what they do is they try to track real-time inflation data using the government's data. So it's not like trueflation, but using the government's data, they actually track what could potentially be for the core CPI right here. So April 2024, core CPI, PCE, CPI, things like that. So what they're thinking of is that the PCE should be about 2.7 and core PCE should be about 2.74. So when I was doing my pre-work here, before I was talking to you guys, it's like, okay, so is that going to be lower than what we're currently at? And then, yes, we are. It will actually be lower. So that what that basically means is that the reason why that's important is that actually talks about the trend, right? Because the trend is what's important here. Like where rates are right now. So the biggest question is where rates are right now. Is that going to be restrictive enough to actually bring inflation down? And that right there is the most important thing to always ask yourself, because obviously we've had 3 or 4 bad inflation reports. This has created a tightening in financial conditions, specifically with the rise of the 10-year. But when we're thinking about like a rate hike, right, something that would actually drop the market substantially, when we're talking about a rate hike, we have to make sure that we're paying attention to the trend. And there is as it stands here today, there is no major acceleration. I know that if we extrapolate this and, exclude this and whatever it might end up being super core, CPI, whatever, there's all sorts of things that we can look at, and just, we can look at it from an optimistic perspective or a pessimistic perspective, whatever we want to think about. But what I like to look at is like, what are they looking at? What do they care about? And that's what's really important for us to think about, like with the market price action perspective, because if they do actually put that rate hike back on the table, the markets will crash. But if they don't, and if they come out, and this is actually really important to show you guys here too. If they come out and they say, yeah, you know what, the trend of inflation right now, it actually looks like, it's still coming down. We're still in restrictive stance. That just basically means that we're going to hold rates steady for where they're at right now, which is exactly what the markets are pricing in. So there's like a 2.5% chance that we get a rate cut, but that's basically nothing burger. That's something to not even pay attention to. What is important to pay attention to, though, is that when I was looking through this, I noticed that in September, so now a rate cut is actually being priced in for September. So if you actually go into like July, so July is a 71.9% chance of being at 5.25 to 5.5, which is exactly where we are today, which basically says that the markets are thinking right now that we are not going to cut in July. We're not going to cut in June. We're not going to cut in July. We could potentially cut in September, which is where the first time we actually see a slight favorability there, because I guess they're even pricing in 2 cuts. And so when you look at the rest of the year, they're thinking that the first cut should come in September. And then when we look at the rest of the year, what the markets are pricing in, it doesn't change that much. So like right here this isn't December. This is the November meeting again. For whatever reason, this doesn't want to change for me. Let me just try to refresh this. So when we're thinking about it from like from the rest of the year perspective, I can kind of remember the data. So I might just talk on that because for whatever reason, it doesn't want to work for me. So when we're thinking about from the rest of the year, the markets are currently pricing in just 1 rate cut for the rest of the year, 0 to 1 rate cut, right? This is a big difference. This is a big difference to start the year, right? To start the year, we were like 4 or 6 rate cuts. Now we're at 0 to 1. This is what the markets are going to be paying attention to with the presser for Jerome Powell. Like, what's the language that they use? How are they thinking about inflation? Like, are they not seeing the progress that they want to see? Like, are they still thinking about the 2 to 3 rate cuts that they ended up having in the SEP? Because this is going to be the catalyst, right? This will be the catalyst that changes the direction of the markets for the next 6 months to close the rest of the year out. Because if they come out and they say, yeah, we still think about 2 or 3 rate cuts, the markets will price in a rate cut, probably making September a lot more locked in. Right now, it's slight favorability. Remember, it was at 44%. Let me just double check to see if this thing is actually loading. For whatever reason, it just doesn't want to load. Oh, there it is. Okay. I'm going to make sure I want to actually share this. And I want to actually show you guys the numbers. All right, cool. We're making progress. This is basically what happens when it's live, right? Sometimes you get stuff like this, it happens. Okay, so you can actually see that to close the year out, we have that 19.8% chance of, hey, we're still going to be exactly where we are today, but we have like 1 or 2 rate cuts. The majority of it, the favorability is 1 rate cut to close the year. So we have that, once again, like I mentioned, that 0 to 1 rate cut beginning to be priced into the markets. This will move. So after this week, when Jerome Powell talks, that will move, and that will impact stocks and how they end up trading. More importantly, like the energy stock sector, because like how is that actually going to impact inflation? The thought process is easier monetary conditions means that gas prices go up because it increases economic productivity. And then also the same side too with like the tech stock sector. Like that, so like right now, tech stocks have just been absolutely blown out to start this year. I mean, down probably about 10%. It's pretty consistent with the 10-year yield because they move with the 2-year, 5-year, and 10-year yields. If they actually end up saying like we do think that there's going to be 2 or 3 rate cuts priced in this year, or we are expecting to cut rates at some point this year, this will come off as dovish. This will be a catalyst to rally. Even though I came out here last week and I said, yeah, I think that the market should follow some sort of pattern like this, where it was going to go up and it was going to come down back into this 200-day moving average. I think that that's still a probability. I think that is absolutely something that can still happen because Jerome Powell can come out and he can be more hawkish and he can say something along the lines of like, because he is going to know the jobs data that's going to come out on Friday. So he's going to take a look at the labor market and he's going to assess his decision there. And he's going to say he could come out hawkish and he could completely surprise the markets and make us go down, another, let's say 4 or 5%, which is really a nothing burger. It's same thing with the NASDAQ here too. Like we could definitely see a further capitulatory move down, or we could just bounce around in some sort of sideways price action to really close out this quarter, which is basically quarter two. So over the next, let's say 2 months. April, May, June. Yeah, so April, May, and June, basically those 2 months, we could potentially see some sort of sideways price action, and we could just have really nothing for quarter two. But that's not what I'm thinking. I'm actually thinking that, and I was probably talking on this, so just to make sure that I'm showing you guys this, that's what I was just talking on. I noticed that I didn't have that pulled up. I'm still learning. But I really do think that what we're probably going to actually see is because of earnings, because inflation is still projected to come down, I do think the labor market is going to come back into better balance. I don't know. Like that's kind of, that's kind of where I'm standing right here, where it's like, yeah, I could see the ABC move downward. That would make sense from a technical perspective. But at the same time, things got really, really bearish really, really fast. And when things like when sentiment swings that fast and that far in the other direction, then that's like my dogs are about to bark. So I'm going to just apologize in advance. Hey, Cody, don't. All right. Sorry, guys. Like I said, live stream. But I do think that because things got so pessimistic so quickly that we could actually end up seeing a short-term bottom here. I really do believe that, especially in high beta stocks. There's been a lot of really pessimistic things that have been priced in. Not only that, but I actually looked at I do care about the seasonality. I do think that the election year is a big deal. I talk about it pretty frequently. Got to make sure I'm sharing I am sharing my screen. Okay. The election year seasonality here. What we end up seeing is that like during that quarter one time frame, and shortly after quarter one is all finished, that we do see like a lot of volatility in the market. The S&P 500, I think, is only up like 4 or 5% now year to date. But what they usually see is that like during election years, that there is going to be that summer market rally until about September or October timeframe, where there is going to be some sort of correction all the way up until the election. And then we should see a pretty aggressive rally to close the year out. So that's really how I'm thinking about the markets here. And this is pretty consistent too. So I actually want to show you guys. It was pretty consistent with, the 2020 timeframe, because that was the last election year that we had. Was 2020, and we had a really bad year, obviously because of COVID, right? But then we had that correction right around here, which basically started in September, and then right after the election. I'm not sure if you guys were around during that, but right after the election, the markets were just rally mode. It was pretty aggressive. It was a pretty robust move. In 2016, it was pretty similar to that too. Really bad start the year. We had a pretty rough quarter one. And then all of a sudden, right over here in this election zone, right there in November, the markets rallied to close the year out. So they were basically sideways, pretty volatile, pretty bad quarter one, and then rally to close the year out. And then we rallied all that next year in 2017. So I do think that there is something to the election year seasonality. And that's kind of what I'm thinking about here from like a longer term perspective here. Okay. So I think that's all I got. I've been talking for about 38 minutes for you guys. I do have a new microphone, so let me know what the microphone sounds like. I hope it sounds pretty dang good. But more or less, to simplify exactly what I was trying to say here tonight, earnings is huge, right? Earnings do influence stocks, and they are companies first. And what the company says and the outlook on that company will move the stock price. I saw quite a few people today, both traders and investors. This last week, traders and investors talking about how the stock market is rigged. It's not rigged, because you can tell. Like, especially if you dig into these earnings calls and if you listen to the call, you listen to the analyst Q&A, you can tell when a stock price is going to sell off or when it's actually going to rally because of the analyst commentary, the analyst Q&A, like how are they going to influence their models, more importantly, like what does the earnings expectations look like over the next 6 to 9 months? And because of because they're companies and Wall Street cares about the company's earnings results, the earnings is what really matters. If they overprice, so in like Meta's case, they priced in too too high of expectations, which is why it sold off. Tesla, same thing. But on the reverse side of it, they priced in too much like bearish things, which is why I think that actually put a bottom into the stock. And now we should start seeing Tesla go up, and Meta, I'm not sure, like it's still pretty decent valuation. So make sure that like during this earnings period, it's not what the results are, it's what the outlook is going to be. And then Wall Street is actually going to price that in as it comes along. It's going to be a very, very busy time period. I'm going to be commenting a lot on that. More importantly, like talking about the bond yields and Jerome Powell, it's going to be very important to see how the bond yields actually move for the rest of the year. We like right now, the 10-year yield is up about 21% year to date. This has influenced stock prices, more specifically long duration stocks. As the yields have gone up, long duration stocks multiple has declined. If the yield is basically like if Jerome Powell puts a top into the 10-year yield, which is basically a bottom into bonds, then what we could actually see is we could see a pretty aggressive risk on rally. That's going to be cleared up here this Wednesday and really provide better context. Now this is a delicate act for Jerome Powell. So I'm not leaning towards one thing or the other. I just know that if he says something along the lines that he still plans on cutting rates 2 or 3 more times, what this is basically telling the markets is that he's going to be telling the markets that you guys priced in, you guys don't have enough rate cuts priced in. Right now, there's 0 to 1 rate cuts priced in. So if he does say something along those lines, I could see that bottom in bonds and a decline in yields to really kick off the rest of this year, which is going to benefit a lot of high duration stocks. What I think in the short term here too is that I think that there is some sort of bottom. I don't know if it's going to be the index low. I do know that high duration stocks, long duration stocks, what they typically end up doing is they bottom beforehand. I know in 2022, a lot of people didn't pay attention to this, but a lot of long duration stocks, growth stocks specifically, they actually ended up bottoming in the May-June timeframe, and they basically traded sideways for the better part of the year. A lot of people really missed that one, where it was like, where it wasn't terrible, but it was definitely volatile. But the majority of the crash happened between January to May, June timeframe for a lot of those high duration stocks. So I do think that there is some sort of bottom that we got going on here. We could see another cut lower, especially if Jerome Powell comes out more hawkish than the market expects. We could definitely see a further selling in equity prices. But I'm leaning more towards that he's actually going to stay pretty consistent. He is going to stay basically with where he was at last meeting, which is the 2 to 3 rate cuts. And I do think that long duration stocks, so high beta stocks, I think they're actually going to start rallying here. I think that small caps are going to really benefit as well. So we could actually see a recovery in the Russell to really for like the next 6 months is what I really have to say here. But anyways, that's all I really got for you guys here. It's a really important week, and I make sure I summarize next Sunday here. So next Sunday, I'll cover exactly what ended up going on this week, what Jerome Powell was talking about, cover a couple of the earnings that I ended up seeing this last week, and really provide a better picture as to like, how is everything shaken out, right? Like, what does the economy look at? I really do pay attention to these earnings because it provides me additional context, like what the boots on the ground are seeing and what they're actually saying. So like, how are business conditions looking from a macro perspective? Like, I don't want to hear some macro commentator talk about liquidity one more time, right? I want to hear like, what are CEOs seeing? Like, because they're the ones that are actually involved in the business and they see the business conditions and they're actually seeing things move. And that to me is more reliable information. Okay. Until next week, guys, as always, you stay classy.